Okay, thank you, Sebastian. And welcome, everyone. Thank you for taking time out of your workday. I know everyone is busy for today's webinar on understanding your credit presented by HomeStreet Bank's Affinity Lending Program. And so what we're going to be talking about today is we're going to go over some credit report information. So kind of just an introduction into what goes into the credit report and what goes into the credit score factors and how those are formed, as well as some items on improving your credit score, followed by some tips and resources. And then I'm going to follow and finish up with some summary of the affinity program benefits for you guys. So before we get started here, I would like everyone to self-reflect a little bit. This will come in later in the presentation. If you could, I'm not going to ask anyone to share anything, but if you could write down or note somewhere how many credit accounts that you think you have. So credit cards, personal loans, mortgages, car loans, student loans, and just kind of note I have 3 credit cards, I have 1 mortgage, or I have 1 car loan, personal loan, etc. And just kind of think about, just have those noted down, and we'll go over that a little bit later, just so you have those ready so that we can kind of compare into the improving your credit score section of the presentation. Okay. So once you have those kind of noted down for yourself, again, I'm not going to ask anyone to share any information. That is just going to be for your own benefit. Okay. So we'll start with the summary of the credit report introduction. Your credit report is a type of consumer report. It's going to contain information about where you work, live, how you pay your bills. It may also show whether you've been sued, arrested, have filed for bankruptcy, etc. Companies called consumer reporting agencies, or CRAs, credit bureaus. This is going to be Experian, Equifax, and TransUnion. They compile and sell your credit information to businesses. And because businesses use this information to evaluate your applications for credit insurance, employment, and other purposes allowed by the Fair Credit Reporting Act, it's important that this information in your report is complete and accurate. So just kind of a summary on what happens with those credit bureaus. For every credit account that you have, again, that's going to be things like credit cards, personal loans, student loans, car loans, mortgages, etc. Each one of those accounts, whoever services that loan is required to report to those 3 credit bureau agencies on a monthly basis. So once a month, they're going to report how long the account has been opened, how much is due on the account, what a credit limit originally was for that account, what that outstanding balance is, and if you've had any late payments. So have you, for however many months that you've had that account, has that payment been made on time? Has it been made 30 days late, 60 days late, 90 days late, etc.? And so each one of those items is going to go into be factored into your credit score. And your credit score is important because your credit score may affect if you are approved for future purchases. And then beyond that, it's also can affect how much you are paying on various accounts. So if you, for example, mortgage rates are a risk-based product. Generally, the higher your credit score, the lower your interest rate can be. And so having a higher credit score can benefit you by having a lower monthly payment on a going forward. So it's also important to check your credit report periodically for inaccuracies to make sure that everything that is going into that credit report is accurate. And because if there is something that you're unaware of that may be affecting your credit, if you catch it early, it's easier to correct than if you catch that later. Okay, so Um, One thing about credit is it is graded just like anything else. And there is not, I don't think that there's nearly enough information on what goes into that credit score. It'd be like trying to take a class and not knowing how you're going to be graded on that final class, on that for the to get your ending grade. So here is a quick breakdown on what goes into your credit score. And the primary factors that determine what's your FICO score. The biggest one, 35%, is going to be based on your payment history for all of your accounts. So are you paying your accounts on time? And if you are doing that, you're already off to the biggest way to keep a high credit score. Okay, and then 30% based on the amount that you owe on all accounts. 15% is based on how long you've been using credit, how long have you had the accounts open, and then 10% based on new applications for credit, and 10% based on the types of credit used. So now going back to kind of where you have written down all of your accounts or noted, how many credit cards do I have? How many personal loans do I have? Car payments, et cetera. Look back at that now and say, have I made all of these payments on time? Great. And then the next one, 30% based on the amount that is owed on all accounts. This is mainly for credit cards. And what they're looking at is the amount that you are using the credit based on the amount of credit that is extended to you. So the balance of your credit versus the limit of that account that they are offering you. And you want to keep that balance lower, around 25%. I'll get into that just in just a little bit also. Another important thing is, so now looking back at the accounts that you have written down, think about which one is the oldest account that you have. So if you have a credit card that you have open and you haven't used it in 5 years or whatever, it's best to keep that account open because it's adding history, longer history to your credit account. And so it will benefit your score to keep that account open and not close it, even if you're not using it. And then 10% based on the applications for new credit. Not all inquiries are created equal. So if you have, I think one of the most common questions that I am getting is, or that I get in my job as a loan officer, is I'm afraid to have my credit pulled because it will hurt my credit score. So what this section is actually doing is really it's looking at how many accounts are you opening. Having a ton of credit inquiries isn't necessarily a bad thing. But if you are opening up a whole bunch of new, if you're say bought a car, opened up a credit card, got a personal line of credit all within 1 month, that's a whole bunch of new information that you're throwing into the algorithm for how they're calculating your credit score. They don't know how you're going to react to having all these new payments, all these new account balances. And so they're going to slow you down a little bit by lowering the credit score until they have more history of you having on-time account payments for those new accounts. So that's when you might see the credit score drop down a little bit when you're opening up new credit accounts and having credit inquiries on your account. Excuse me. And then as far as mortgage credit inquiries go, they do recognize, the credit bureaus recognize that a credit inquiry for a mortgage does not necessarily mean that you're opening up a mortgage account. It also recognizes that their mortgage shopping is becoming much more normal practice for when people are looking to buy a home. So what they do is they clump all of the mortgage inquiries within, I believe it's 30 or 60 days together, and that counts as one inquiry, even if you look with three or seven lenders, whatever you're looking at. Okay, and then 10% based on the types of credit. So look at your list again of the types of accounts that you have. It's good to have a little bit of diversity in there. You're not required to have, say, if you only have a like 1 or 2 credit cards and no other credit history, but you've paid everything on time, you may have a good credit score, but it might not be the top credit score because you haven't demonstrated that you have the ability to take on different types of credit, such as installment credit, like a car loan or personal loan. Okay. And then I see that we have a question in there. Will the slides be available? Sebastian, are you able to answer that one?
Yeah, absolutely. So, Ryan, I can message you later and we can send these slides out to everybody if that's okay.
Okay, great. And I'll also have my contact information available at the end. Please feel free to reach out with any questions on anything that I'm going over in this. Okay. And then, so if you, when I asked the question in the beginning to kind of take a note of what credit accounts you have, if you do not have any, and you know that you do not have a credit score, what you can do to get a credit score is open up an account and have that open for at least 6 months. I have seen credit scores show up in as little as 3 months, and that is the best way to get a credit score. The easiest way to do so is to, if you have no credit history and no credit, is to search within an institution that you already have a relationship with. So if you do your checking and savings with HomeStreet Bank, they already know who you are and you're a customer. They might be more willing to give you a credit card or open up a personal loan for you, as you're already a customer. So if you find yourself in that category, start searching within places that you already have a relationship first. Okay. And then a little bit beyond that, at least one undisputed account reported to the credit bureaus in the past 6 months. We'll go over the disputed and undisputed accounts in just a little bit here. And then finally, no indication of deceased on the credit report. That's pretty self-explanatory. So we'll just kind of go into a little bit more depth on, or I'll just summarize again, basically improving your credit score. So again, paying your bills on time, the number one factor in having a high credit score and keeping a high credit score. Utilize the payment reminders through your banks, whatever institution that you have the account with. Consider it enrolling in automatic payments for your credit cards and loan providers. So even on the credit card, if you pay off your credit card every month, maybe set a automatic payment of just the minimum payment in case you are traveling and unable to make the payment. At least you've made that minimum payment, or you have that minimum payment as a backup just in case you're unable to make that full payment on your own. Okay. And then set up a budget to ensure that you have the money necessary to pay your bills on time. And then if you're having trouble making ends meet, contact your creditors or a legitimate credit counselor. So if you find that you're falling behind on credit cards, maybe getting a personal loan to consolidate some of those higher interest credit cards into something that's a little bit lower and a fixed rate going forward. Okay. So payment history shows that you've paid the accounts over the length of your credit. This makes up 35% of your credit score. A few late payments are not an automatic score killer. An overall good credit history can outweigh 1 or 2 instances of late credit card payments. So going back to those percentages that you had, if you have one missed payment or one late payment, again, this is not, the payment is due on today's the 13th, payment's due the 15th, you don't make the payment till the 17th. That's not what's going to show up on your credit report. This would be a 30-day late. So you've gone through the next billing cycle without making at least the minimum payment to go forward. And so going back to those percentages, if you say you have one ding on your credit for a missed payment, but you have a very deep history of, so you've been making on-time payments for 20 years, one missed payment over the 20 years might not be a big deal. Now, if you don't have a lot of credit history, you don't have a lot of accounts, and you have one missed payment, that's when you're going to see a big drop in the score as a result of just one missed payment. So it's good to have a nice round and diverse background in credit in order to maintain that higher score. Let's see here. Okay, so I think I covered all of that. Okay, so reducing the amount of debt you owe. So again, on those credit cards, you want to keep those balances around 25% of the credit limit. If you have a credit limit of $10,000 on a credit card and you consistently have like $9,000 balance on that, that's where that's going to hurt your credit score. If you get that that down to closer to 2,500, that's where that's kind of the sweet spot for maximizing what that credit score is. Of course, you always can pay off those every credit cycle and not have any negative effects as well. Pay off debt rather than moving it around. So, excuse me, sorry. While you can improve the credit score by instead of having a bunch of revolving credit debt and then move it into a fixed loan, that can temporarily increase your credit score. Let's see here. The best practice is to make sure that you pay off the debt and have a lower overall balance. And again, do not close existing accounts as it may lower your credit score. I went into that a little bit earlier, but again, it's all about having the most credit history and filling up as many of those boxes on that credit percentage or on those credit factors. Okay, and then I also touched on limiting applications for new revolving debt. Again, this is more about opening up multiple accounts at once as opposed to just having just looking into potential credit. And it looks like we do have another question there. So would it be good to apply for more credit cards to increase the total credit limit? Could having more credit cards hurt FICO score in other ways? Yes, and yeah, I think that's a great question. So if the main thing that is hurting your credit is the total balance on the credit cards, as opposed to the limit, having again, moving that balance to limit ratio back down to 25 by opening up more credit could potentially lower the credit score. Balance that out with the new accounts. Again, adding the new accounts they might try to slow you down a little bit temporarily, but if you keep the balance consistently at 25% when you have opened up a new credit card to keep that balance lower relative to the limit of the credit card, the total revolving credit limit that you have, I think you'll see that balance out. I think that could potentially help the FICO score. Okay, but again, it comes down to also how many different credit accounts and the credit history that you have. So if you have a ton of credit history and the only thing hurting you is that balance, then adding another credit card to make that balance to limit ratio better, that could potentially work, yes. Okay, and then so how do I correct errors on my credit report? To correct errors on your credit report, it can be a very tedious process. You will need to contact the credit bureau that is showing erroneous information. You often have to do this through whichever credit bureau that is showing up with. So there's the contact information for Equifax, Experian, and TransUnion. Sometimes these can be done online through those websites there. Sometimes that can be done over the phone. And then sometimes they will, depending on what the error is, if there is documentation that you need to provide to them, it does have to be mailed. So that's why it is important to stay on top of your credit um, awareness and make sure that you're aware of what's on your credit report. And so I'm going to I'm going to add a link into the chat there. And so the best way to keep track of your credit information is to use that website, annualcreditreport.com. On there, you will be able to pull a credit report for Experian, Equifax, and TransUnion actually once a week now. Up until a couple years ago, this was once a year. I think this was a great change for all consumers to be able to access their credit reports on a regular basis and make sure that when you pull those credit reports, you're looking, okay, I do have all of these accounts that they're showing. These are all open, or hey, they're showing an account that I didn't open up. I need to address this with Equifax, Experian, TransUnion right away. And or if I wasn't aware that I had a collection out on this account, let's get this taken care of so I can fix my credit right away. Okay, and that it looks like we have another question here. I called a bank to be removed as an authorized user, but I still see it on my credit report. Would I need to call the bank again, or would I call one of the bureaus? That's a great point that you brought up there, because on top, generally, you will want to make sure that the information that you're looking to correct is both received by the credit whoever is extending the credit and by all of the credit bureaus. So these they don't generally talk to each other. So you want to make sure that everyone is on the same page with that information. So I would confirm with the bank that you have been removed as the authorized user. And then I would also notify if you pull the credit report and you see that you're still an active authorized user on those accounts, I would go back to the credit bureaus and notify them all and dispute that information with all three of the credit bureaus as well. Okay. So I'm going to give you a quick summary of the Affinity Program benefits, and then I will open up the floor for some additional questions. So as part of the Affinity Benefits Program, we are able to provide you with discounts on your mortgages. So if you're purchasing or refinancing a home, we're able to provide specific discounts to you as with your employment through the University of Washington. You can also double up those benefits by using a participating realtor. On the retail side of things, we're able to provide you with exclusive workplace checking, as well as discounts on new vehicle and personal loans. For specifics on the vehicle loans and personal loans, I cannot help you with those, but feel free to reach out and I'd be happy to get you in touch with someone if you're looking at getting a new car or a personal loan and getting a discount on those as a part of your affinity benefits. Then down payment assistance information. All of the affinity loan officers are trained and willing and able to help you out guide you through the process of the down payment assistance program that are programs that are available in your area and guide you through that process. We do have other financial fitness tools and seminars throughout the year. So please keep an eye out for those. So some home ownership things, some budgeting practices, home maintenance, things like that throughout the year, as well as monthly newsletters, toolkits, and more. One more thing is the benefits are available to immediate family members. So if your parents are looking to buy a home, or if you have kids who are looking to buy their first home, they're eligible to use those same benefits when buying a home through the Affinity program. All you need to do is just get them in touch with an Affinity loan officer and let them know that you want your family member to use the benefits as well. And we just need to verify your employment through the University of Washington, and then they're able to use the same benefits. And a reminder, the Affinity Benefits are only available through an affinity loan officer, so you will need to get in touch with an affinity loan officer to use those benefits. Okay, and with that, I will go ahead and open up for any questions that anybody has.
Ryan, I have a question.
Yeah.
So I guess with different types of loans, like conventional, like a first-time FHA loan or VA loan, does my credit score, like, does my required credit score, is it different for each of one, or is it kind of just all the same?
Yes, so there are different loan programs available for different credit scores. So if you find that you're in the lower credit score category, we do have the FHA loans that are available. And those just have different, they're just set up a little bit different. And then we do have, generally, if you're over 700, you're probably going into conventional a loan program there.
Got it. Thank you.
Okay, another great question here for bill payments. Are one-time bills, say medical bills, treated the same way as regular credit card bills? Some great news on that front is um, they're moving towards having medical credit or medical bills removed from um, factoring into your credit score. A lot of that has to do with um, a couple of things. First off is generally nobody is allowed to ask any questions in regards to the medical bills. So if there is a late medical bill and there are questions around it, there's not a lot that we can really do to ask and find out what's going on with that. So the medical bills are being slowly removed from those credit reports. I don't think I've seen one in quite a while. And we are not allowed to treat them negatively on the credit report. And then as for bill payments, just to kind of expand on that a little bit. So things that don't show up on the credit report are things like utility bills, cell phone bills, stuff like that. Um, those can be manually added to the credit report. If you would like them added, there can be instances where you're self-reporting your bills to the credit bureaus and trying to boost your credit that way. But on their own, those are not showing up on the credit report.
That last part that you just said, is that kind of like the Experian Boost or whatever they call that program?
Yes.
Okay,
So that they're also looking into doing that beyond Experian Boost as well.
awesome. Thank you.
I have not experienced the Experian Boost having an immediate impact for mortgage credit scores. Um, one thing I did also meant to bring up in the beginning is there's different types to make things more complicated for you as the consumer. There's different FICO score models. So there is a consumer and then a lending FICO model. So a consumer model is going to be what you might see if you have Check My FICO on a credit card account or within like your checking account app or whatever. You might be able to see what's my FICO, and I would say, and that it's the same score, but it's scaled differently. So I would take off about 20 points from that if you say, oh, I have a 760 credit score based on the app that I just looked at. And then you apply for a mortgage and oh, it's about 740, and it's the same score, it's just scaled differently. Okay. And then it looks like we have, so credit reports only consider loans and credit card payments. They will not consider, generally, yes, unless you manually add those. And then how can you remove new credit application history? I have 3 new credit applications, but only 2 of these are more than 12 months. So uh, uh, think about 120 days is how long an inquiry is the window for where they're bunching together general credit inquiries. So you can't actually remove any application history, but if you extend that beyond 120 days, it's not being bunched together the same way.
Awesome. Are
Okay.
there any other questions that anyone would rather ask, or ask, whether it's either chat or feel free to unmute yourself? Oh, got one here.
Yeah, yeah. So there's you might hear this referred to. FICO inquiries are not treated the same way. What I mean by that is there's soft inquiries and there's hard inquiries. So a soft inquiry would just be, I want to check what my FICO is through that app. So that they know that you're not actually applying for credit. You're just dipping into the system to see what your score is, as opposed to if you submit an application to open credit with a credit report or the credit card or a car loan or personal loan. Yeah, so differences between the FICO score and kind of a lending credit score. The reason why those are different is if you are opening up why credit cards are showing you a different score than, say, a mortgage lender is giving you a different score, is because credit cards are just worried about what they can claim through a bankruptcy filing, and what they can get back from a bankruptcy filing. Whereas a mortgage lender is looking at what are the odds that you as the consumer are going to fall 30 days late on a mortgage payment. So if you are applying for loans or auto insurances, very often they want to check FICO score. Is that a hard inquiry or a soft one? I would say if you're applying for loans, most likely that's going to be a hard inquiry. For insurances, that's most likely going to be a soft inquiry. And you can always ask anytime someone's going to pull your credit. Um, First off, they should always get your authorization before pulling credit, whether that's via the internet, or over the phone or in person. And you can always ask them if that's going to be a hard inquiry or a soft inquiry, and they will answer you.